So in this video we will be looking at the descending triangle chart pattern, and this is, at least in my opinion, a pattern that all traders should learn. It is very useful, and if you use it correctly you can definitely improve your trading. So yeah guys, we will start this video off by taking a look at how does the pattern look like and how do we spot it, and then after that we will take a look at how do we enter. So we will take a look at some strategies for when to enter and some entry points, and then after that we will take a look at how do we take profits. So what are some profit target levels that you can use on this pattern. So if you think that sounds interesting, then I really hope you will enjoy this video. Real quick before we start though, I have to give a disclaimer that this video is for educational purposes only and nothing in this video is financial advice. But alright guys, now let's get started right away here. But alright, so what you can see here on the chart is a very large descending triangle looking pattern. And this is actually Bitcoin, and this is a daily chart on Bitcoin. It's, in my opinion, a very iconic, descending triangle. And if you want to look it up, this one started at around the beginning of May 2018, all the way to the breakdown we had right here on around November 14. So a very large pattern. But let's right away jump in and take a look at how does the pattern actually look like. Let's take a look at some theory. Alright, so the descending triangle looks something like this. We have a downtrend, or most of the times we have a downtrend. I will return to this later in the video. But then we actually find support at this purple point. We find support and then we bounce from this level. We see resistance after the bounce, and then we fall again to the same support level. But then, this is very important, on the second bounce, we actually don't reach as high as we did before. So we actually print a lower high, right? So when you have, two bounces at the same support level and one high and then a lower high, then we are starting here to develop a descending triangle. You can also see, a bounce at support once again here on the purple point, and then you can see yet another lower high. But eventually, the point of this descending triangle is that we will eventually, or most of the time, we will actually break down here. And because of this, the descending triangle is something we call a continuation pattern, meaning that most of the times the pattern will break at the same direction as the trend. So in this case, we have, prior to the pattern, we have a downtrend. So continuation patterns will most of the time break in the same direction as the trend. So in this case, we often say that the descending triangle is a bearish continuation pattern because it suggests that we break to the downside. But as always, when it comes to technical analysis, and this is very important, we always talk about probabilities and there are no certainties. So this pattern can actually break to the upside. And when a descending triangle breaks to the upside, it can actually act as a reversal pattern. But most of the time, it is a continuation pattern. Let's actually take a look at our example on Bitcoin and why that is a descending triangle. So as you can see here, prior to the chart, we had a downtrend. We found support a bit above this white line, and we saw a bounce and printed a high. Then we came down here and found support, multiple times at around this white line. We saw a bounce, and then importantly, we printed a lower high. So one high, and then we printed a lower high. We fall down once again, saw buyers coming in at this white support level, and then we printed yet another lower high. And one thing you can notice already is that this pattern is not perfect. You can see, for example, this high right here is not exactly at this line, but this is, very, very common. When you trade in real life, your patterns will almost never be, perfect. The important thing here is that you get a general sense that we're talking about a descending triangle. After this high, we fell down, saw support at this level multiple times once again. You can see that we saw a little bounce once again to, in this case, to this white line. And then finally, we broke down. And when we actually broke down, you can see we saw a very strong and accelerated force here to the downside. So in my opinion, this is a very nice example of a descending triangle, almost a perfect example. But as we said, you know, if this high would have been a bit higher, maybe it would have been a bit more perfect, but still, this is clearly a descending triangle. All right, so now let's switch our attention and take a look at how do we enter our trades here. What are some possible entry points for the descending triangle? And the first point you can enter is basically here at the breakout. So you enter when you get a clear breakout, or sometimes you call it a breakdown because we break to the downside. So the breakout here can definitely be an enter point. A second way to enter is that you wait for a bounce here, and hopefully you will get a bounce up towards the previous support level, and then this level can act as resistance. And if you get a bounce around here, you can many times find a nice short entry at previous support that flips and become resistance. So this is two possible entry points. We can call it the breakout, and we can call it the pullback. So let's take a look at the chart again and how this would look like in real life. So in this example, one way to enter here would that you could have waited for this candle, this day to close, because when this day closed, we had a clear candle close below this white line. So it's a pretty clear breakout, and you could enter right here. And in this case, you would have made a pretty nice profit. Some traders prefer to wait for some confirmation candles before they enter. So as you can see, after this breakdown, we saw some candles right here, some red candles, and some traders like to see, you know, at least one, sometimes two, maybe even three candle closes below the structure before they decide to enter. Our second method of entry was to wait for a bounce, and in this case, as you can see, we never really got a pullback here to retest this previous support as resistance. So if your strategy here would have been to wait for the bounce and enter up here, then you would have missed this trade completely. So that is one side. So that is one downside with the pullback entry, that sometimes after a breakout, the price will just continue down and you will never get a clear bounce where you can enter your short trade. The positive thing about a entry on a bounce is that you often get a better entry point. So if you enter a short up here, you have more downside and can make more profits than if you enter, you know, down here. So there are ups and downs with the different methods, and both of them can be good, but it's pretty much up to your personal trading style, what suits your risk profile the best, and so on and so on. Now let's take a look at target levels. So targets. If you trade this pattern, where do you take profits? To show this, I think it's easiest to take a look at the real example right away here. So one very popular method to use to take profits is to use the 100% measure move. And what you do here is that you measure from the high of the first touch of the resistance line to the low of the triangle, so to the low right here, and then you take this measurement, the length of this measurement, and then you measure here from the breakout. So if we would have used this 100% measure move, then we would have had our target all the way down here at around 2,300. And as you can see, in this case, we actually never reached our 100% target. So sometimes, especially when we have such a large pattern, you know, this pattern was very, very large. So sometimes the 100% measure move is a bit too, optimistic if you're a short trader. So there are other ways to measure as well. For example, one thing you can do, let's say you have a short position right here. And let's say that you have your stop loss just above these highs we had right here. And a common ratio is to have a risk reward ratio of 3. So in this case, you would have taken profits, you know, down here. And if you would have had a risk reward ratio of 3, and your stop loss around the highs right here, then you would have gotten almost a perfect trade from this pattern. So, when taking profits, you always have to, look at, for example, how large is the pattern compared to the trend? Is it reasonable to use the 100% measure move? What is my own risk profile, and so on and so on. But two methods you can use is the 100% measure move, which we talked about. And you can also use, a risk to reward ratio that suits your personal trading style. But alright guys, that's pretty much it for this video. If you feel like you got any kind of help or value, then please consider dropping a like. And if you guys are interested in more, then don't hesitate to subscribe and hit that notification bell. I hope you guys have an awesome day, and I hope I will see you guys in the next video. But for now guys, take care. Ciao ciao.